Hello and welcome back to another session on mortgage secondary market, which is often explained as a process. What is mortgage secondary market as a process? So secondary marketing process basically consists of following again different sub processes like loan sales, the product pricing, and then we have pipeline management, risk management, and shipping and delivery. What is exactly the loan sales? So selling the whole loans and the participations and the mortgage-backed securities by the lenders and the borrowers. Product and pricing, basically price loans in correlation to ever-changing market forces so that the company produces value from the loans it produces. And the pipeline management, keep track of the warehouse line limits and requirements. Using the pipeline reports, estimate how many loans will close, when they will close, and how the company will fund those closings. What is risk management? Monitor and manage the risk in the mortgage market, such as the interest rate fluctuation. Shipping and delivery. The preparing and delivering the documents to investors as quickly as possible to avoid the interest rate risk, to meet commitments and to tolerate the warehouse line for new lending. All right, so let's understand each one of that process, sub-process in details. First one is loan sales. So a bank's secondary marketing department working with the production management is responsible for developing, pricing, selling and documenting and delivering the mortgage products to the investors. A bank must consistently demonstrate reliable performance in underwriting, documenting, packaging, and delivering the quality mortgage products to remain in the good standing with its secondary mortgage participants. Poor performance of the loans sold could lead to unfavorable prices for the future sales or the terminated relationships. All right, so let's understand what is product development. Mortgage loans sold to government-sponsored agencies must meet each agency's specific underwriting and eligibility guidelines. FHA and the VA loans are eligible for sale into GNMA securities. Conforming conventional loans and certain FHA and VA loans may be sold into FNMA and FHLMC securities. Non-conforming, like jumbo conventional mortgages, non-conforming conventional mortgages and the mortgages which do not meet the agency underwriting guidelines may be sold through the private label securities or to private investors. The secondary market department should ensure that the loan products the bank intends to sell meet the guidelines established by the investors before offering a new type of loan. The secondary market department should determine its marketability and consider the bank's ability to price, deliver, and service the product. The bank's legal counsel and the compliance personnel also should review new products to determine if they comply with the applicable laws and regulations. All right, what is the credit enhancement? In tandem with the bankruptcy remoteness, the credit enhancement is what enables investment grade debt, like triple B minus and above, to be constructed from the loans pooled by and or originated by the companies without investment grade ratings themselves or with the ratings below those of the security they issue. The level of credit enhancement is determined by credit rating agencies like Fitch Ratings, Moody's and the Standard & Poor's based on the collateral quality, servicer rating, issuer reputation for the due diligence and other factors. So credit enhancement typically come in one of the three forms like insurance, over collateralization and senior subordinate structure. So insurance is the catch call name for the external or the third party credit enhancement provided by the bond insurers. Corporate guarantees or letters of credit. Over collateralization, it basically involves selling the bonds to the investors, the face value of which is less than the total collateral balance of the pool, a positive collateral to bond balance ratio. In effect, this structure uses the excess collateral as a form of insurance should some of the individual loans default. What is senior subordinated structures? So senior subordinated structures provide a credit enhancement by prioritizing the payments, such as the losses, are taken first by one or more junior classes, thus protecting the higher rated senior securities. All right, let's understand what is loan pooling. Loan pooling. So a bank can sell the mortgages in the secondary market as an individual loan or as part of the as part of the pool of loans. Pools are generally made up of loans with similar characteristics such as product type, underwriting terms, interest rate, original or remaining maturity, and the payment frequency. Banks that originate a substantial number of mortgage loans normally pool them to sell because it produces a higher price and reduces the transaction cost. Loans are also may be swapped for the pass-through certificates issued by the investors. That is, the investors on the securities produced by the FHLMC. In this transaction, the bank gives up a portion of that interest income on the loan, generally 0.25% of the loan amount, in return for more liquid asset and more favorable risk-based capital treatment. The bank retains servicing of the loans which back the certificate. All right, let's understand what is mortgage, processes and product and pricing. So mortgage pricing. So the secondary marketing manager deals with the two prices. The one the investor pays to purchase the loans, and the second the price quoted to the production staff and the borrowers to produce the loans. To the production staff, the price consists of interest rate and the required discount quoted for the particular loan type. Investors basically supply the lenders with a pricing course that show the lender that what they will pay for a loan will give an interest rate for delivery by a given date. So in the below chart, whatever the chart you're seeing shows illustrate the price of an investor will pay for a loan based on the loan's interest rate. Higher the interest rate will make the investor more money. Therefore, the investor will pay more for a loan that yields more than the current market rate. Okay, so the borrowers who want a below market interest rate pay an extra fee called as the points to the lender. The points charged are based upon the price the lender gets from the investor. For example, a price of 98 requires 2 additional discount points from the borrower. Pricing can be risky to a lenders. Okay, the lenders often commit to giving the borrower specific interest rate without making a commitment with an investor. If the lender thinks interest rate will decline, the lender will wait before making a commitment to the investor, hoping to get the better pricing. However, if the interest rates goes up, the lender will have to sell the loan at a loss. Each company has a different ways of managing this risk. It's a very tricky situation. Pricing strategies differ significantly from one institution to the another. Most bankers continue to use the old rules of thumb or follow the leader in pricing. When setting prices, they generally analyze the market to see what competitions are doing. When pricing for the profit, mortgage bankers should set the rate locks by analyzing the profitability on a loan-by-loan basis, taking into consideration of some of the variables such as origination and overhead cost, junk fees collected or the paid, value of the servicing created, cost of the hedging fallout risk, differences in the hedge cost and the value of servicing. So the net interest earned from the expected loan closing date to the MBS settlement date, or interest spreads from the expected closing date to the forward commitment settlement date. Pricing by these methods enables the mortgage banker to avoid selling mortgage loan assets for the prices that are lower than their economic value. There are all different types of gas stations the secondary marketing person can select to sell the loans to. If the company has the funds, it can keep loans in inventory and it can sell them for the cash, sell to the conduit or securitize them. The secondary marketing staff can also mix and match to get the best price of the day. Generally, the companies will focus on what they know best, such as the primary cash or the mortgage-backed securities. So the mortgage, pricing is closely, tied to the mortgage-backed securities market, the servicing option and the remittance cycle also influences the price. Price quotes for the FNMA, FHLMC, and GNMA mortgage-backed securities are readily available on automated security screens at most secondary marketing departments. Because of the guarantee fees and the normal servicing fees, mortgages are typically sold into securities with the pass-through rates 0.5% below the mortgage note rate. If the security price for a 60-day forward 8%, 30-year FNMA is 99, and the bank must charge its customer one discount point for an 8.50% 30-year mortgage to be priced at the market rate. During periods of aggressive competition, banks occasionally offer their mortgage products below applicable security prices at a marketing loss. For example, an 8.50% mortgage with no discount points. Alternatively, banks sometimes price their mortgage products at a premium to the market. For example, an 8.50% mortgage with the 2 discount points. What is guarantee fee, float, and remittance cycle? The amount of guarantee fee the bank pays agencies and the private guarantors is negotiable. Guarantee fees are based on the amount of risk assumed by the bank and the timing of the cash flows paid to the investor. The longer the guarantor holds the mortgage payment, the smaller the guarantee fee necessary to compensate them. Investors have different requirements for accounting cutoff dates, payment schedule, and the remittance dates. FNMA and FHLMC allow the seller to either buy up or buy down the guarantee fee. These options provide the bank the flexibility for increasing or decreasing the amount of excess servicing. If the bank buys up the guarantee fee, that is, pays a higher fee to FNMA or FHLMC, it increases the amount of cash it receives in exchange for a smaller excess servicing fee when the mortgages are sold. When the bank buys down the guarantee fee, it receives less cash from the sale in the exchange for a large excess servicing fee over the life of the underlying loss. All right, let's understand what is pipeline management. So the pipeline is usually described as the period of the time between the interest rate lock and the sale of the loan. Using the pipeline reports, the manager estimates how many loans will close and how the company will fund those closings. He or she keeps track of the warehouse line limits and the requirements. Typically, a mortgage banking company maintains a high leverage, and little capital. Accordingly, it must use its warehouse lines effectively to ensure the availability of the funds for the loan closings and for the particular loan programs. To accomplish this, the secondary marketing manager coordinates with the finance department, monitors the cash requirements constantly, and anticipates these needs as soon as available. There are certain key concepts in the pipeline management. Let's learn about each one of them. First one is the warehousing. If a loan is sold on the secondary market, a mortgage investor will pay the lender an agreed upon price of the loan. The lender needs a short-term source of funds for the period of time between giving the borrower the loan at the closing and getting that money back from the investor a few days or months later. Sources for this funding include mortgage warehousing, a short-term revolving line of credit that is most typical form of financing used by the mortgage bankers. Alternative sources such as the repurchase agreement, commercial paper, federal home loan banks, stable funding. So these are some of the things which are happening during the warehousing. A warehouse bank is usually is basically a lender's lender. A mortgage banker borrows money from a warehouse bank to loan to a consumer. The mortgage banker then sells the loan to an investor in order to repay the warehouse bank. So after this, the mortgage banker can borrow the money again and start the process over. Next key concept is the line of credit. The mortgage lender receives a warehouse line of credit to borrow the money for the short period of time. So it's generally like a few days to months. The credit line approves the mortgage banker's borrowings up to a specified maximum amount for a specified time. The dollar amount of the credit line is determined by the lender's financial strength, lender's expected monthly income, and average length of the time the lender borrows money from the warehouse credit line. All right, the third concept is collateral and wet settlement. A warehouse line of credit is usually secured by the collateral. The collateral for the line is made up of mortgage notes payable to the lender, which have been assigned and delivered to the warehouse. So the term warehouse lending refers to what banks once were, a warehouse of the mortgage banker's loan documentation. As the mortgage banker drew against the line, it provided much of a loan's closing file to the warehouse lender. The warehouse loan documents could include almost anything the lender might need in the event the warehouse line went into default. A warehouse may make a portion of the line available on an unsecured basis for the wet settlements. This is usually a more risky type of credit and may require a higher interest rate, shorter time, and the greater financial strength on a part of the lender. So the next concept is outstandings. The funds currently on the loan to the mortgage banker are referred to as outstandings. Lenders are charged interest on the outstandings. The interest rate is normally floating and is based on the warehouse bank's prime rate. Lenders can use a tool called compensating balances to lower this interest rate. By maintaining a compensating balance, lenders pay a lower interest rate on the outstandings. Next concept is the fees. Also, the most warehouses charge the lenders an additional form of compensation. Although there are many miscellaneous fees that may be charged, one common type of the fee is the commitment fee. A commitment fee is an annual charge for the use of the line of credit. Alright, next concept is the haircut. The amount advanced to the lender by the warehouse against each mortgage note is actually less than the face value of the note. The difference between the amount advanced and the face amount of the note is called as the haircut. The percentage of a haircut varies based on number of factors, but is usually around 5%. For example, at closing, a lender loans a borrower $100,000 for a purchase of house. The borrower signs a mortgage note with a face value of $100,000 payable to the lender. The lender assigns a note to the warehouse lender as a collateral and withdraws $95,000 as a line of credit. The warehouse lender retains the difference of $5,000 called as the haircut. Next one is the warehouse risk. So if the lenders leaves the loans in the warehouse for the period of time, their value may change as the interest rate change. The warehouse bank may require additional collateral or require that the balance be reduced in order to compensate for the loans that we have declined in the market value since they were closed. This is called as the curtailment. For this reason, most of the loans placed in the warehouse are usually designated for sale to a specific investor at a specific price on a specific date, 30 to 45 days after closing. Loans that have not been protected with this type of commitment are more risky type of collateral. All right, what is risk management? So the risk secondary marketing manager's overriding concern is to achieve the volume and preserve the value of the mortgage pipeline for a sale in the secondary mortgage market. Risk management is the process of reducing the risk while maximizing the profit potential. From a lender's perspective, risk is the potential that events expected or unanticipated may have an adverse impact on the bank's, the capital or the earnings. The primary risk associated with the mortgage banking are like credit risk, interest rate risk, and the fallout risk. There are a few other risks as well as such as the price risk, transaction risk, and the liquidity risk. These categories not mutually exclusive. Any product or service may expose the bank to multiple risks. They are discussed more fully in the following paragraphs, like the credit risk. What is credit risk? Credit risk is restoring or the capital arising from the obligors failures, to meet, the terms of any contract with the bank or otherwise fail to perform, as agreed. Credit risk is found in all the activities where the success depends on counterparty, issuer, or the borrower performance. It arises anytime banks' funds are extended, committed, invested, or otherwise exposed through actual or implied contractual agreements, whether reflected on or off the balance sheet. What is interest rate risk? Interest rate risk is basically like, is the risk to earnings of the capital arising from the, movement in the interest rate. The economic perspective focuses on the value of the bank in today's interest rate environment and the sensitivity of that value to changes in the interest rates. Interest rate risk arises from the differences between the timing of the rate changes and the timing of the cash flows, from changing the rate relationship among different yield curves affecting the bank activities like basis risk, from changing the rate relationship across the spectrum of maturities, yield curve risk, and from interest related options embedded in the bank products, which is called as option risk. All right, the third risk which we are going to discuss is fallout risk. An applicant may not be able to close his or her loan because of one or more of the following reasons: interest rate increase and the borrower no longer qualifies for the loan. Demographics of the mortgage banker's loan customers are such that many cannot qualify. Product types are different to the market. Underwriting standards result in loan rejections. Ability to process the loans does not meet the demand. Rate locks expire and cause the loans to fall out. This is all about the fallout risk. Price risk. Price risk is the risk to earnings of the capital arising from changes in the value of the portfolios of the financial instruments. So this risk rises from the market making, dealing, and position taking activities in interest rate, foreign exchange, equity, and commodities markets. All right, so what is transaction risk? Transaction risk is the risk, is a function of is risk which arises due to lack in the internal controls, information systems, employee integrity, and operating processes. To manage the transaction risk, a mortgage banking operation should employ competent management and staff, maintain effective internal controls, and use the comprehensive management information system. To limit the transaction risk, a bank's information and record keeping systems must be able to accurately and efficiently process large volumes of data. All right. Liquidity risk. Liquidity risk is the risk to earnings of the capital arising from a bank's inability to meet its obligation when they come due. Without incurring unacceptable losses, liquidity risk includes the inability to manage the unplanned decreases or the changes in the funding sources. Liquidity risk is also arises from the bank's failure to recognize or address the changes in the market conditions that affect the ability to liquidate assets quickly and with a minimum loss of value. So what is hedging? So hedging is something which basically provides the mortgage banker an opportunity to offset one risk with a deliberate acceptance of another risk that is more or less predictable. Often the offsetting price movements are not perfectly matched and there is some net loss or the net profit from the hedging. Hedging basically helps mitigate two primary risk: fallout risk and interest rate risk. What are the different options? Is an option is a contractual position that gives the purchaser the right but not the obligation to sell or purchase the loan asset at a different specified price. So the buyer or the seller does not have to take or convey the delivery of the assets unless he or she decides to execute the contract. Options are good for hedging fallout risk since they do not suffer from the basis risk, and also the loss potential is limited to the premium paid for the option. All right, what are the futures? A financial contract where the mortgage banker agrees to make or take the delivery for the mortgage financial instrument in a standardized amount by a future date. Futures provide the mortgage banker a profit if the mortgage price decline after an interest rate increase. However, they have a risk of higher potential loss than other instruments. All right, let's learn about what is shipping and delivery. A successful mortgage banking company requires a very good shipping and delivery department because the work of this department allows the company to meet its sales commitments and remove the loans from its warehouse. Meeting these objectives enables the company to improve its bottom line. In secondary marketing, after the loans have been pooled and priced in the different forms of the products, the document management and the third party certifications are essential for selling off the loans in the pool. Third party certifications add value to the pool of loans and encourage its marketability and make it more sellable. What is document management? So, to fulfill its delivery responsibilities, the banks must obtain all the mortgage documents for its investors. Front end documents are obtained before or at the closing. Post closing documents such as the mortgages, assignments, and the title policies must be recorded by local authorities or issued by the title company. Post closing documents may normally be received up to 120 days after the closing. A good tracking system for document collection activities is necessary to ensure its effectiveness. What is five-step process? The shipping and delivery staff is responsible for coordinating all the activities and departments involved in packaging and delivering the loan to the investor or its agent. The five steps of shipping and delivery are matching the loans and the commitments, checking the loan files for the original documents, making copies of the documents for the lender's records, preparing transmittal documents, and shipping the loan documents. What is the delivery commitments or matching the loans and the commitments? Each investor requires different schedules and the documents in order to make a good delivery under the terms of the commitment. If the lender does not deliver the loans as required under the terms of the commitment, it is known as a failed delivery, and the lender can be subject to the penalties or to the pre-pricing of the loan at a loss. Investors, the purpose delivery is see to that commitments to investors are fulfilled within the specified deadlines and according to the investors' commitments. What all the agency investors? They use the shipping software that checks for the errors and prevents the entering of the correct values into the system. Such systems are like MOR and ET Mornet for the Fannie Mae and MidaNet for the the Freddie Mac. For example, if the shipper inputs are incorrect, payment for a certain term, interest rate, and the loan amount, and the program will not accept it. Who are all the private investors? Generally, they want the shipping package to be in a precise order. The shipper must make the copies of every form to retain the company's loan file, as a private investor may want all the original forms shipped to them. So that's all about secondary market as a process. I hope you enjoyed this session. Thank you for listening. I will see you in the next chapter.